Hey friends, everybody, you know that we put out a survey, I'd say about a month ago, just asking you all, what did you want were? And overwhelmingly, it was, you wanted to hear thoughts from Sean and myself directly, what we're seeing in the market, what we're doing. In short, you wanted a voice. And so that's what we're delivering on today. And not only that, we're going to have a lot more of these Zooms to come. And I think the best topic right now is the market. Obviously, the market's been very weak, very choppy at best, and difficult. But one of the things is we are here for the long term. And one of the questions that Sean gets all the time is, how have you lasted 20 years in the market? And Sean always preaches about discipline. But Sean, you've seen it all. Can you maybe tell everyone a little bit more about how you truly operate? What are the mechanics of sticking it out?
Sure, Greg, and thanks everyone for joining us. We are going to try and make this weekly and send in topic requests and just anything you want to hear us talk about. Also, if there's someone else from the team you want to hear talk, we're more than happy to get all of us on. So yeah, I mean, the markets are pretty bad now, but they could get a lot worse. So in about 20 years of the market, I have seen a lot. And where we are now is probably, I wouldn't say it's that bad. It's not great, but it's pretty much, there's a lot of nervous investors out there and pretty volatile. People just don't know where it's heading. So yeah, I mean, I've seen a lot of different bear markets, bad markets, yeah, not so bad markets, boring markets, everything. And I think the key to longevity in the market is, as you say, being disciplined and not being aggressive in the bad times. Keep your aggressiveness for the good times, or when. So, I mean, at the moment, it's high risk. There's a lot of decent opportunities, but you don't want to get caught holding too much, and things could turn pretty. I mean, if we get full-on war in Ukraine and things do get nasty, look out, it's not going to be fun, and it can drag on for a long time. So I guess the biggest sort of message would be just be cautious and don't have too many eggs in one basket. Don't have too much in riskier stocks, because they'll be the last ones to bounce back. And as you've probably seen, the liquidity dries up. So yeah, now's the time to be smart.
Right. And Sean, you know, a lot of investors, they've actually come to the market in the last 2 or 3 years. Frankly, they've never seen a down market. Can you just tell them also a little bit about, maybe, do you, without getting too much into the weeds, do you reduce your volumes by 10%, or is it much more dramatic than that?
Greg, I think you've seen me during the day. On bad days, I'll probably get up from out of my little room over there at about exactly 10:15 and give a few curse words and leave for an hour or two and just try my hardest to stay away from the screen, because yeah, when it's bad, it's bad.
And then does that stop you from catching the knife? So
exactly. So there's the more you sit there, the more good opportunities you think you're seeing, but the next day it might be a better opportunity. So yeah, it's when it gets like this, just don't go for maximal returns. Just protection is the best word. Protect your capital. Don't do what you were doing a year ago. But yeah, as you say, a lot of people have joined the markets recently, and for those that joined, let's say from June 2020, you've had probably the best market that I've seen in, I mean, probably ever.
And you've seen a lot, yeah.
I've seen a lot of good markets, but June 2020 till about the end of last year was phenomenal for everyone. If it wasn't phenomenal for you, maybe get another job. But yeah, I mean, we just saw different sectors, sector after sector heating up, and so many different themes in the market. And the scary thing is that a lot of it was built on COVID, and I still don't think we've seen the true impact of all the printing of money and unemployment and all the bigger economic hurdles that I still think we're going to face a lot. So I think we may be starting to pay for it now. But yeah, if you did join the market early in 2020, and you would have seen that massive correction and then all upwards from there. It's not always like that. It's we're finally seeing what is not a great market, and fingers crossed it gets better, but no one can predict what's going to happen.
That's right. And Sean, you touched on the word protection. How do you protect yourself? And one of the things here we're always still looking to do at 180s, we're still looking to make money with protection. And that's why we are happy today to introduce to you what we call LDUCs, or 180 branded LDUCs. And what it stands for is a long duration upside contract. And effectively what it does is it offers you a huge amount of protection with a lot of upside. And at the same time, it gives the companies the ability to raise capital later at much higher prices, especially if they're confident that they have news flow coming. But to talk about the structure of it, Sean, how it actually works, let me turn it back to you.
Thanks, Greg. Yeah, so in terms of LDUCs, a lot of you have emailed us asking us what it is, and it's actually a made-up word that we use here at 180 Markets. So don't go Googling it, because there were some dirty terms there that we found on Google. Yeah, so what we are going to talk about today is a different strategy that people can use when the market gets like this, and something that we're doing a bit, and we're going to show you examples of ones we've done. And yeah, it's just, I mean, we've had a lot of requests for different alternatives to placement, so we thought we'd introduce you this one today, and we will probably have one of these on the platform next week. So yeah, a lot of you would have heard of the Bergen Notes. They were a really popular way of ripping off companies in probably
That's right.
From about 2005 to about 2015. A group called Bergen offered these notes to many companies on ASX, and at the end of the day, Bergen did really well off them. I won't go into the details of those notes, but there's now a more popular version that we're using that protects the companies from those sort of getting ripped off, because these notes used to really only suit the investor. So we use a note that suits a company as well. Basically, when a company is in a downtrend, like most of them are now, we've offered companies the notes, and basically what it is it's a longer term note, but with a lot more upside. So longer term, it's at least 3 months before you can convert your shares, and it protects the company from immediate dilution. So the company that we probably going to do it for next week is a company with massive upside, but a terrible looking chart.
That's right.
It's fallen a lot, and it doesn't want to raise money now, because if it did, it would be at a massive discount. So what we've proposed is that investors put in their money now, and in 3 months' time, they can convert it at a price that is about 30% higher than where the price is now, or a 20% discount. We're not going to go into the details of it, because we'll go into it when we have live deals, but these are just different examples of what you can do in a bad market. And something like this, there's a lot of options as well. So it's structured in a way that's going to protect the company, the investor, but giving both parties a maximal upside.
Right. If you were going to think about it from a structuring point of view, you as the investor, you have essentially a put on a downside and then 2 call options on the upside. So for example, say a stock was trading at 5 cents a share and it was going to go up and the exercise price was 8 cents a share. Even if it runs up to 20 cents a share, you can still buy it at 8. So you have that real big upside. And then on the downside, they're usually convertible at some type of discount to the VWAP. So you have that downside protection as well. Every one of them has slightly different wrinkles, but in short, it gives you a lot of protection on the downside with that huge upside. And as Sean mentioned, from the company's point of view, what's so important for them is that they're extremely confident that their share price will be higher, but they need those funds to kind of get around the corner. And that's what we're providing for them.
So we wouldn't say that there's minimal. I mean, there's minimal risk. I think that's the best way to say
Correct.
it. The risk is that the company goes insolvent and delists from the ASX. So most of you would know that there are so many investors out there that would just take capital raises as long as there's a price, that we see that risk as being extremely low unless the markets completely collapse.
Correct.
So if the markets completely collapse and there's no more capital raises, then you're going to lose your money in these companies.
Right.
The odds of that happening, I mean, even in a terrible market, you can still raise money for companies. But look, it may be at a low price, but in these notes, you're protected from that. So one thing we've put in there is that you can be bought out at the end. And if you don't convert along the way, then you should get your money back plus free options, which if that happens, options will be worthless, but it's very hard to lose with these. I won't say it's impossible, but look, if Russia invades Ukraine and Ukraine invades the world and the world ends and there's no more financial markets, then you're going to lose money anyway on a lot of other things. So,
well, sure, but we were discussing it before. We said as a portfolio basis, if say we were going to do 5 or 10 of them, on average, say you'd make 15 to 20% types of returns across the board, but then you'd have one that would really explode, that they'd have a company making type of project where the share price really would go nuts. And that is the huge upside. And that is all you need, really.
That's right. So obviously it'd be great to do 1 every 3 that you get that. But there's 2 criteria for us. One is that there's no debt already, and if there is, that it's not a big problem for the company. Correct. And 2 is they do have that upside. So they will be drilling, or biotech with massive potential, just something that has the ability to be a 10-bagger, maybe even more. So yeah, in a nutshell, that's the LDUC. A lot of, we've done, the last one we did was, I mean, we can say KNM.
Yes.
About 3 months ago.
I think more, I think in October.
Yeah, so maybe 5, 6 months ago. Most people have made 15%, get free options. There was no big event during the period, but I mean, the share price did go up a lot, but it wasn't the 5-bagger they were looking for, but it definitely was a nice return.
And you have the options still.
You have the options, and I mean, the company just did another capital raise, so usually that's what's going to happen. This is just something that we thought we'd introduce as an alternative to the normal placements. And at 180 Markets, we've been lucky that the market's been good, and we haven't really put convertible notes on the platform, but we see it as a better way, not a better way, but if the market does go bad, then we are going to have more of these opportunities on the platform. And yeah, we wanted investors to just understand them before because hopefully they'll be pretty regular.
Correct.
And yeah, so It can be confusing for those of you that haven't been around the markets for long. So we'd love to open up the floor to questions. Don't be afraid to ask anything, even if it may seem simple or something. We're more than happy to answer.
Definitely. So Ariella, why don't you open it up?
Yeah.
You can
Or
also,
unmute yourself.
or you can also message at the bottom.
Okay, I'm getting, someone just WhatsApp me. Sean, can you just explain, if you want to convert, how did you convert? What's VWAP? Like, how does a price being set?
Okay, so there's two different prices that could eventuate. If the company does really well, so I'll use a K&M example because this is the one we did. So we did it when the share price was, I think, 1.2. We set in there a maximum price of 1.5. So had the shares gone to 3 cents, we would have converted at 1.5. But the shares are around 1.5 now. So they've actually done all right. I mean, they did go to 2 at one stage, but that was still in the patch where you weren't allowed to convert. So now in the conversion period, you can convert at a 20% discount to the 15-day VWAP. So let's say that the VWAP, 15-day VWAP's 1.6, then you get to convert your shares at about 1.3, I think it would be, a 1.25. And then you can do whatever you want with them.
And you also don't have to convert all your notes at once.
No, you can convert, K&M was $25,000 a note. So you can convert each note at a time. So if you put 100 grand in, you can convert all at once or 4 different patches.
Okay, so Brent would like to know, how do the loans work for tax purposes and how do you report it to your accountant?
Any accountants on here, we'd love to hear from you, because I'm guessing it works in the way of shares. Like when you sell, you pay the tax in that financial period.
I'm 90% sure, but I don't want to give you Brett 100% answer.
I've got my dad in here. He's an accountant and he loves his accounting. So Dad, if you got any ideas, feel more than free to unmute yourself.
Okay, next question.
Okay, so it's a question regarding the options.
Yes.
So when do you receive your options and do you have to convert your shares in order to get your options?
Yeah, you have to convert your shares and then you get the option. So
At the same time.
if it's like, so K&M, I think was 1 for 2. The one we're working on now is, I think, 1 for 1. The amount of options will depend on how many shares you get. So if you convert at a low price, you're going to get more shares and then more options. So I guess the only bad thing of the price going up a lot is you convert at that maximum price and you get less options.
But you make more money.
You make more money. So the options are really the extra free upside that we're talking about here. If we pick a 10-bagger, you're going to make a lot of money on, I mean, if you hold on to the shares, then awesome, but the options, a lot of these ones will be unlisted because you need 50 investors to list them. So yeah, you'll get them when you convert, unless the company buys out the note at the end. Most of them will have free options, but if that happens, the options, I'm guessing, won't be worth a lot because you would have converted if things went well.
Right. But again, you know, when it comes back to the way that we're looking at it here, because I know you want to hear from us, we look at it on a portfolio basis. If you do 10 transactions and one of them, or 5, and one of them hits, that's really all you need.
10's a lot.
Okay.
Okay, so next question. Will the notes typically attract an interest rate?
No. So the way we've structured ours and the ones upcoming, unless the company is determined not to give us options are instead of interest. So it benefits the company because they don't need to pay cash out, and it benefits the investor, well, the high risk investors who want options, because that's what's going to give you a great return.
And bear in mind, you can convert it at a discount as well.
Correct. And with interest rates so low these days, I don't think you're going to do something like this for a few percent. It's options that are really exciting.
That's right.
For these notes, and we'd rather have that extra upside and the potential of massive returns than earning a few percent.
Exactly.
Okay. Is there a minimum amount of investment for these offers?
Usually $25,000 per note, but yeah, well, I mean, we've seen quite a few notes around, and some of them are more, some of them are less.
That's probably about normal.
It just depends. Yeah, 25 is probably normal.
Okay. If the company goes into liquidation, does the LDUC provide a right as secured creditor before conversion to shares?
The ones that we've seen and done are unsecured.
Yeah.
Usually you're not going to get returns like this for secured debt.
Correct. But there's also still a shell value for the companies almost in every situation. And we also do look to see if there's debt in front of you.
So one of the, what we've seen in markets when companies don't survive and they can't raise capital, they usually go, they delist and they become a shell, and people put money into it with a new project. So I'm pretty sure that if that was to happen with these, you'd get your money back. Maybe there'd be negotiations where you get 70 cents in the dollar. But I haven't seen a market where companies can't raise capital. When we started and COVID hit, there still were capital raises. They were at discounts and companies were desperate for money. They just do raises at very low prices.
Correct.
Under the 15% rule now, you can raise money pretty much at any price if you can't do it at the normal 20% discount type thing. So
Correct.
We'd be amazed if the companies couldn't raise more money. Look, it could happen. That's a risk. But there's not a lot of cases of like smaller micro caps that we've seen not being able to raise money.
Correct.
Usually there's a reason like that, something that we probably would have seen before, hopefully.
Yes.
Okay.
Just a second.
Guys, feel free to ask any questions, interrupt us, unmute yourself.
There's quite a few questions in the chat, so
Okay.
I'll just read them out.
Okay.
Sure. And if you want to ask us something else, not LDUC related, more than happy to answer.
Okay, so are the notes structured to avoid shareholder approval under LR 7.1, or will there be a risk that they have to go to shareholder approval?
Usually not. Some do need approval if there's no capacity, but I think they're allowed if the company does have capacity. These notes are often used when the company doesn't have capacity. For those of you that don't know what capacity is, it's companies are allowed to issue 15% of their shares each year for capital raises, and they are allowed to request an additional 10%. So capacity is usually between 15 and 25%. So it depends on the company, but they don't usually need. The risk is that the notes take up all the capacity, and then when you try and convert, the company needs to go to a meeting. But one of the terms that we've seen in all these notes is the company must have the capacity or will request the capacity for shares and options.
Correct.
So it's not straightforward, but usually yes.
Will there be an expiry on the convertible note, i.e. do they have to be converted by a particular date?
Yeah, I'd say 95% within 12 to 18 months. You're laughing, Ariella.
So this question someone's asking, it's essentially a convertible note with options.
So there's quite a few differences. The first difference and the main difference is you can't convert for a few months, usually 3. So,
And that buys the company time, and that's what the
That's-
companies are looking for.
so companies now don't want you to convert now for at least 3 months because they either feel like they've got a event coming up that will improve their share price or the market will improve. So it's usually done by companies that need capital but don't want to dilute now. So the old convertible notes, the old Bergen types, were pretty much from the get-go, they convert, they sell, they convert again, they sell, convert and sell. One restriction that may be placed on investors is you can't do more than 1 conversion in a month. And I mean, we've seen that once or twice. So they're different things that differentiate. And in a lot of the old Bergen notes, there were options too. So yeah.
Those are the big differences.
I mean, there's heaps of different types of convertible notes. There's convertible notes that we're seeing a lot now for pre-IPOs, where people invest before an IPO, but it's in a convertible note where it converts at a 20% discount, let's say, to the IPO price. Those usually don't have options, but some of them may. So they're very flexible.
Okay, and last one, unless anyone has any more questions, can you convert at any time? So we already...
Yeah, so usually after 3 months you can until the notes expire. But I mean, some of them may be 6 months, some of them may be a year before you can convert. They've all got different time periods, and yeah, it just depends on the terms in the note.
Correct.
Okay, you say they can't be converted before 3 months. Will this be stipulated on the convertible note, or is this what the company prefers, that you don't convert them within 3 months of issue?
No,
It will be a term on the note. So it's, as we say, all notes are different. And
yeah.
some you may only be able to convert on at an event. Most of them are going to have the time period written in
That's
clearly,
right.
so you see how long you've got to hold for.
And that's what makes them unique,
Yep.
or ours unique.
Anyway, so that's just one thing we wanted to cover off, the LDUC. If there's anything else you guys want to, I mean, there are many different strategies that you can use in the bad market. We are probably going to have another Zoom in 2 weeks on something else. And yeah, we just thought we'd bring this one up today just so you can hear from us. And we're still here. We're struggling with the market. It hasn't been easy. It's pretty much everything we've done has gone down, back to raise price, and you just got to be smart now.
But Sean, also, can you just give investors in your history, out of a 12-month year, how much time do you really need to really have a great year? In other words, can't you make really all of your money in 1 or 2 months?
Make all your money in 1 or 2 weeks.
There you go.
1 or 2 days.
So you have to survive the others.
You have to survive the others. But let's say over a 20-year period, you may have a great 6 months and then a terrible 2 years, but you just hope in that 6 months that you made enough to get you through.
So you just need a little window.
Yeah, I mean, one thing I always say to people is the market will always be here.
That's for sure.
Well, we hope so. But you don't have to sit by your screen when the market's bad. Yeah, I like to, on days like yesterday,
Go
I
boxing.
don't know, I mean, I wanted to go boxing. So you got to know that the market will be here tomorrow. It's you don't always have to be risking capital in times like this. There'll always be placements, there'll always be different opportunities. So yeah, just do whatever works for you.
Ariel, you said a couple more questions.
Yeah, just A few people are asking me if it's going to be recorded, the ones that are coming late. Yes,
Sure.
it will be recorded.
So we'll put it on the platform later or tomorrow. And if you can't find that, send us an email and we'll send you a link.
Yes.
And lastly, just about the conversion. So if you convert at the VWAP discount, if you convert some, can you convert the rest at the maximum price?
Yes. So
For
you
shares,
don't
right.
need to choose. It depends on the time you convert. So if you convert, let's go back to K&M. If let's say the shares are 2.3, then you convert at 1.5 because that's lower than the 20% discount. But then let's say that the share price falls to 1.6, as in the VWAP, then you convert, when you're converting more, about 1.2, 1.25.
Correct.
And you get those free options and yeah.
Right.
Look, it's it's not, I mean, there's also time before you get your shares, normally about 3 or 4 days. So you request to convert, the company has to work with the registry to issue the shares. Sometimes it'll go to an SRN and you'll send us an email complaining where are my shares,
Right.
and Ariel and Jake will fix that up for you. But yeah, it's normally pretty smooth once you're familiar with it.
Got it. Okay, everyone, it looks like that's about it for now. Seriously, we're here for you. Anything, if you think about something 5 minutes from now, just let us know. And as Sean said, we know that you want to hear more from us, and we're going to make it our business to make sure you hear from us.
Just before we finish this off, we're going to wait about a minute. And if anyone wants to ask a question, just unmute yourself. Thanks, everyone.
iPhone B.
From Brent.
Oh, wait.
Thanks.
One more question.
Sure.
What's the turnaround time from conversion to share issue? If it's
About
a while, there is no advantage to the discount in a falling market.
correct. If you do it and it takes 2 weeks for the company to do it, then you're going to lose your 20% in a falling market. I mean, 20% is a lot, but usually 2 to 3 days maximum, as long as the company knows what they're doing and they've got a good registry. It shouldn't take longer than 2 days because you're not relying on transfers of money. Yeah. And then the other risk is it goes to SRN and you've got to wait another day for it to go into your HIN.
How do you protect investor capital from slide after trading halts as they issue the shares after 6 to 7 days?
So there won't be a trading halt when the company issues the shares. I think, I don't know if this question is referring to a note or a usual placement. I think he's referring to the placement. Do you want to
Can you
confirm?
just clarify?
Yeah. Or feel free to unmute yourself.
Let's just say that was in regards to placement, because that's when there is a trading halt. You can't protect yourself if you can't short. So a popular method now is in mid caps and very liquid stocks, usually market cap, say over
500 million.
I mean, even 150, 200 mil, you can short sell stocks before people get their shares. It's very hard to do, but it's a common, I mean, if you were able to protect yourself, then you could consistently take placements and beat the market. Placements aren't designed to beat the market. I know it might seem that way because you're getting it at a discount, but placements have to be priced at a discount to entice new investors. Otherwise, investors could have just bought on market anyway. So yeah, it's very hard to protect yourself from a falling price after the company's out of a trading halt.
Okay. Well, thank you again, everybody. Be well, and we'll talk to you probably next week.
Thanks, everyone.
Bye-bye. Thank you for watching another presentation by 180 Markets. Don't forget, If you want access to thousands of ASX capital raises, head on over to 180markets.com.au, sign up, and get on board for our very next capital raise. Thanks for watching.